And Kingsley, what part of the country do you call home?
Yeah, Greater Boston,
Boston.
Northeast. Yeah.
All right. So you're cheering for the Dodgers in the World Series then.
I haven't heard of the Dodgers. That's I used to root for the Patriots, but there are better things on TV in the past couple of years.
Yeah, the current version.
Like
Current version.
Yellowstone.
Yeah,
Current version not as good as the Brady Belichick era of dominance.
yeah, yeah. It's changed a bit.
Rich, is that the big thing where if you are a Mets fan, do you root for the Yankees because it's New York, or do you root for the Dodgers because of the National League?
I mean, I got a lot of Mets fans in my life. They all loathe the Yankees and are all the biggest Dodgers fans I know this next week. So it's typically the way it goes. My experience has been Cubs and White Sox fans hate the other team, and Yankees and Mets fans kind of hate the other team. We'll cheer for anybody over them, really. I mean, there's of course exceptions, but I think that's the. I'll lean on the chat if I'm wrong there, but that's been my experience. So, but
All right.
all right, let's go ahead and get started. This is the big picture. Rob, your hands up already.
Yeah, I was going to say, it seems like there's been perhaps a move in the younger generation, which would include Kingsley, to almost root for individual players
Hmm.
rather than the teams. So, like, people will watch the World Series and maybe root for just good baseball or individuals to do well versus an entire team. I know that there are people out there who hate the Warriors but love Steph Curry, for
Hmm.
example.
Yeah.
Mhm.
So, anyway, just a thought. Go ahead.
I can relate to that. There's actually a bit going on with how we kind of think that the young people think about climate risk. They have climate anxiety, and they're also really concerned about, frankly, celebrities and social media. I'm here to tell you that Tate McRae and Doja Cat, they're going to be all right. But Florida man, that's who you got to worry about. And I think we'll talk a little bit more about that region today and kind of how that may manifest. But the climate anxiety seems to be a little bit attached from the risk, at least in 2024. But going forward, there's a lot we can do today to prepare and kind of invest in more resilience and minimize the worst outcomes.
Rich, obviously, Kingsley has little or no time for sports chatter.
I mean, if you're a national climate risk expert, something's got to be, I think, probably moved out of your life. It probably takes some time to learn all and know all that.
Yes.
Climate or catastrophe? We should ask him about that.
We'll get into all that. We'll get into it
All right.
all.
All right.
Let's go ahead and get into it. And this is the big picture. I'm Rich Swerbinsky with Onward and Upward Consulting. Thank you all for joining us. As always, pleased to be joined by my esteemed colleague and co-host, Rob Chrisman. And Rob, you flew down to Florida just for this show into the epicenter of climate hell.
Yeah, I am gazing out at Palm Beach, Florida, across this looks like Orlando or so many other Florida towns or cities that just, have a bunch of white stucco high rises rising off the, flat jungle.
Do you have any climate anxiety right now being in West Palm?
I don't, but there's a lot of talk among the attendees about the storm. This is the first time the group has gotten together since the storm kind of moved through the area. There are people here, one or two that I've talked to, with homes on waterways, which apparently are quite desirable. And they talk about how some waterways are better protected than others. But it is a concern, and it is a concern with people asking questions about insurance and what are other parts of the nation seeing and why, and are insurance companies going to become insolvent because of the fires and the floods and the wind damage and so on. So
All
there's a
stuff,
lot.
yeah, excited to get into today with good segue. Our guest, we're very excited to have. He leads the mortgage risk analytics practice at Verisk Extreme Event Solutions. It is Kingsley Greenland. Kingsley, thank you for joining us today.
Yeah, pleasure to be here. This is my favorite topic. what I do for work, societal interests, and it's become, I
Sexy.
think,
Climate risk is, dare I say, sexy right now.
there's pros and cons to that. I think that if I look across what a average borrower, an average investor would be able to consume, it seems that some of the climate signals have been over attributed, in the sense that when you see a hurricane coming in, you would read news and think that, but for plastic straws and barbecues, you wouldn't have hurricanes in Florida. And I'm not so sure that that's beneficial toward us understanding not only what the risk is today, but how it may change in the future. And I emphasize this a lot in that in 2024, climate risk is real, it's material, but it's mostly a function of built environment and inflation. So a great example of this is when hurricane was coming toward Tampa. I looked it up. I said, well, when's the last time that we had something that was this bad, this serious? Let's say that it's the worst case scenario. Well, that already happened in like 1926. We had a Category 4 direct hit right in Tampa, 20-foot storm surge, and this is in pre-anthropogenic forcing. Forget that. Pre-global warming climate regime. We had hurricanes hitting these areas directly, and we built gigantic, wonderful cities there anyway. So you need to separate that component of the conversation from how the risk of these perils may change and have changed already from embedded 1.3 degrees Celsius to the different forward-looking scenarios and climate models, which consider a wide range of carbon emissions and how they may manifest in different parts of the globe.
So Kingsley, we should clear something up for Rich right away.
Let's do it.
And Rich, when we talk about extreme events, we don't mean your yearly wiffle ball tournament. We mean something, global, or at least
I was just typing, I was just putting it in the chat GPT to decipher what Kingsley just said there, but thank you for clearing it up for me.
Well, Kingsley, correct me if I'm wrong, but what you're saying is there are shifts in the globe, and then which are different than, say, a catastrophe.
Yes.
And at the risk of losing our entire New Orleans listeners and viewers, humans shouldn't tempt fate by, erecting billions of dollars of infrastructure in areas that are prone and possibly becoming more prone to events like this. Is that correct?
Yeah, that seems fair. And if they do tempt fate, then I think it's appropriate to charge and price in an actuarially fair insurance premium. I think for long-term resilience in the banking, lending, and investment community, it's appropriate to embed not only a view of what the gross loss is without insurance to determine how sensitive that asset is to insurance support, but also sensitivity of how that pricing and availability may change over time. Those analytics aren't perfect, but it's better than the current state, which for most lenders, it's, hey, let me take this appraisal, these financials at a snapshot in time. Do I qualify? All right, flip it through secondary, and then no more thought to the asset. Whereas if you have something like, 7 to 10 years for a mortgage, I think this group knows that a 30-year mortgage isn't a 30-year exposure. It's very rare that they're going to last that long due to prepayment, defaults, et cetera. But even over 7 to 10 years, those opportunities for the insurer to put the risk back to the borrower, and by extension, the lender, well, they have these 1-year annual renewals. So the same way that you would look at different options, you need to consider that at origination, and the analytics exists to do that.
Interesting. We already have a comment in the Q&A.
Okay.
It says Kingsley, an expert on climate risk, and his last name is Greenland. Is that your given birth name, or did you didn't change your name for your career by any chance? Because it is it is a great name for a climate risk expert, Greenland.
Appreciate it. No, it's just merely coincidental, but I have to clarify, Greenland is kind of icy, whereas Iceland is kind of green. So full disclosure, it's not by design.
I maintain a very popular best names in the mortgage industry list. And Kingsley, you immediately, I think you're going to slot somewhere between like 25 and 40.
Okay.
The panel is still, weighing a lot of new submissions, but
Right. The Blue Ribbon Commission is still weighing the submissions. And by the way, Rich, you should know that Kingsley actually has a pipe in the hand that we can't see, and a martini on the table next to him there. Kingsley, if you were a lender headquartered in Florida,
Okay.
what kind of concern would you have, or what questions would you be asking, or where should their focus be? Is it too big of a problem for a lender to deal with, or is it enough just to understand what's going on out there?
Well, depends on the size of the institution. If you're a mega national bank, I think you're in a position where you get one of the only free lunches in town, which is diversification. So the same way that a large global insurer or an international reinsurer is able to retain some of that risk because they can split it out, I think that the biggest banks are going to be okay to continue lending in Florida. Smaller banks, depends what you read. Some of them will suggest that they have on-the-ground expertise. They know flood risk. They know coastal exposure. So no one is better to originate a loan with the right risk than someone who's on the ground. But there's also the case that if I'm a small community bank, a credit union, I'm not necessarily in a position going forward to have that concentrated risk from one single event that could wipe me out. The way to manage the exposure, whether you're a large bank or a small bank, the first step is to assess what the risk is. I think we tend to get in climate, look at it either as inevitable, there's nothing we can do, or it's so far in the future that it's going to be a 20-year thing. I don't need to think about it today. Well, the past few years have shown us, not only in terms of losses, but insurance frictions, that we have unpriced natural catastrophe, environmental risk in the existing mortgages. We didn't price them that way. We didn't think about it. So no matter the size of the bank, there's no better time than today to run the collateral through a catastrophe model and understand your exposure to these risks in the same view that the insurer is using to price them.
Good answer. I was just down in the exhibition hall at this event in Palm Beach, and one of the booths was sponsored by a company named Fembi, Fembi. Have you heard of Fembi?
No, I haven't. No.
They are a wholesaler who only does business in Florida and Puerto Rico. And they do business with primarily credit unions and small banks and small broker shops who broker loans to them, to Fembi. And I thought, well, that's a little bit of concentration risk that I don't know if I would want, but I wasn't going to get in a verbal sparring match with these poor folks who are just, handing out M&Ms or, and so on. But it is an interesting business model, and they're very happy with their niche, Puerto Rico and Florida. So
I hear about the floor or the worst case scenario of this idea of a Minsky moment where everything reprices at the same time and we have this calamity. I think that exists, but I push back against this idea of an uninsurable property or collateral that you can't make a loan against. That's not precise enough language. Maybe it's just that you can't do it at a price that makes sense for the available pool of borrowers or buyers. You can insure pretty much anything. You can lend against pretty much anything if the price is high enough. But if the demand is dislocated from that, then you'll have a couple years of friction. But if you talk through the use case of someone who is not, they have a mortgage on the property and they just can't get insurance. Nobody's going to insure the property. Well, that's a problem for the bank, but somebody else is going to come in at some price and move into that collateral. So that limits the whole neighborhood contagion. It limits this kind of Chinese style empty city, field of dreams, building someone's going to be there. So I think depending on the geography, you're still going to have people who are willing to live in Key Largo, beautiful place. People are still going to want to live in Tampa. The price just might be different, so it could limit the pool of borrowers and reduce it over time. But I think that the floor is a little bit higher than we think when we first say, "Oh, what if I can't get insurance?"
I'm gonna shift outlets. Talk among yourselves for a second.
Okay.
And Kingsley, what are lenders doing? Yeah, I think you said, the first thing lenders need to do is to kind of assess and underwrite the risk. If you're like a small community bank in Florida, you lend just in the state, and maybe you're putting some or all of your loans in the portfolio. What are lenders doing to mitigate that risk, after they've assessed it? And then kind of a follow-up question to that, lenders that sell all their production or most of it into the secondary market, still risks that, exist for those types of lenders. I'm assuming different than those that hold the loans in their portfolios, but I would just love to hear your perspective on lenders have been, because this is such an emerging issue right now in the mortgage industry. I really, been in the mortgage industry for 30 years. I've never heard of, really, I've heard more talk about climate risk in the last year and a half, 2 years, in the 28 before that. So I'd love to just hear your insight on that.
Sure. Well, it goes back to maybe 2015. You had this Paris Agreement where I wasn't in Paris. I didn't agree to anything, but our betters decided that we were going to limit temperature to 2 degrees C, or more than halfway there. So that gave them sort of regulatory authority to go back to their countries and tell the banks that they need to start measuring and accounting for how much emissions they're doing. And through that, a lot of banks and financial institutions started looking at climate models, because climate models are fundamentally designed to say, all right, what's the climate context, the atmosphere today? And then if I hit it with certain amounts of CO2, different emissions, how does that change in the future? So we did that work. But then in focusing on this future, we kind of realized we don't really understand as banks and investors what our climate risk is in the near present context in 2024. And we got there pretty quickly, but really when you say it's been 18 months to 2 years where this conversation has become more mainstream, I think that's a function of changing insurance pricing and availability. I wasn't locking loans in 2005, but I don't think people were concerned about qualifying based on insurance availability. So if you transition that to how does a portfolio lender view this risk differently than an independent mortgage bank that's just selling on to Fannie and Freddie? It depends whether the independent mortgage bank retains or releases servicing. Yep. Because it's my conviction that even if you don't portfolio the loan, you still have responsibility to do the extra work to service it when natural disasters occur. And you don't get into the business of servicing to have high contact with your borrower, right? It's supposed to be this passive clipping coupons. So if I can take any given exposure and put it into our software and tell you what the physical climate risk is, then a smart servicer should intuitively use the same thing and integrate that into pricing and their retain release decisions. Now, for portfolio lenders, it's a function of two things. One, why am I retaining it versus releasing it? Like if I'm originating jumbo loans because it's $5 million Miami property, candidly, the feedback I hear from banks is, well, this is coming from my wealth management division, so I make more money on those fees than I do on originating the loan, so I'm happy to give it to them even if there's a little bit of extra risk. I think the least priced lunch here is on the non-QM or high LTV, low FICO borrower. And the reason for that is that at least in my conversations, those loans are made not because people care about the fundamentals of the economics, but they're saying, hey, we need to get cash and capital into low income communities. So we're not looking for reasons to charge rural borrowers more money just because we've discovered a new risk. We're not trying to add LLPAs onto New Orleans. They have enough problems already. So I think that kind of explains where some of the dislocation is. But as we've seen with other price things, it can change really quickly. And when everyone rushes for the door at the same time, I think the outcome is consistently worse than if you manage and price well up front, as painful as that may be.
Yeah, that all makes sense. And yeah, that was good insight. So IMBs, may make more sense to sell service released if
Mhm.
property is in an area where you feel like there could be some climate risk. And yeah, I think you covered in detail portfolio lenders, what they're doing to mitigate it. Talk for a second, if you could, Kingsley, though, about those climate change, climate modeling versus natural disaster modeling. Are they correlated? The changes that many perceive are happening with the climate, is it correlated to what feels like more natural catastrophes?
Let's talk about hurricanes first, because those are, yeah, that's the national news, the big hurricanes. And just to kind of table to the side that you have dozens of billion-dollar events that happen in the country in any given year that you just don't hear about.
Yep.
But the hurricanes you do. Now, some of the basics that we know. If the air gets hotter by 1 degree Celsius, there's this rule where the atmosphere will hold about 6 to 7% more water. So you have this fairly straight, fairly accepted line that as things get warmer, you're going to have more water for the same events. Yet you can push against that and say, well, it's not every time. And just because there's more water in the air doesn't mean we're going to have more precipitation. But it's directionally fair. The other piece is that climate models do a really great job of simulating things like ocean temperature. Well, we know just looking at the historical record that there is a positive relationship between warm sea surface temperature and hurricane formation. I mean, warm water is hurricane fuel. That's not something that people really debate. But does hurricane formation necessarily translate into landfalling hurricanes? And can we really say, hey, it's going to hit Miami this year, Tampa next year? No, we don't know that. And when we project forward how we think these things may manifest, at least the data I've seen, it's not as dramatic in terms of landfall as it is in terms of hurricane formation. When I read headline news, this constantly just repeat and repeat and repeat, is global warming leads to increased frequency and severity of natural catastrophes. Maybe, sometimes, it depends on the peril. So any chance I get, I bring this back to, well, let's kind of work on the exposure side first, make sure that we understand the risk today, and make sure that we don't make things any worse in the future by continuing to build in flood zone bullseyes and pushing up against the urban wildlife interface and just exposing ourselves to wildfire risks that you can almost see it coming. You build something right on the woods, right near the wrong area, and you can do something about that. So I kind of push back against the blanket claims. It's a problem, but not necessarily as straight line as a lot of media would suggest.
The you talk about building in prone areas.
Yes.
My mind keeps going to areas along the California coast, especially
Yep.
south of San Francisco,
Mhm.
in a town called Pacifica, where people, or Malibu, or down in Southern California, with these wonderful views of the ocean,
Mhm.
but they're building on a cliff.
Yep.
Well, this thing called erosion,
Right.
which is bound to happen. And then you have a situation where somebody's house becomes uninhabitable,
Mhm.
And then they will go back to their insurance agency or whoever and say, well, we want, we want a new house,
Mhm.
right? Or cover our multi-million dollar home that fell into the sea.
Mhm.
And you shake your head and say, why did you build there?
Right.
What were
Yeah.
you thinking? And the same
Yeah.
thing happens, I think, with New Orleans, right? In terms of, I mean, isn't there's some percent of Nolans, which is under sea level, I
Mhm.
think. So
Well, my comment about New Orleans is that they rebuilt, which that's done, right? And then they reconstructed the levees, the Army Corps of Engineers, to the same once in 100 year 1% tolerance that failed during Katrina. So, put differently, based on the own data from these agencies, we're in a worse place, if not more so, in terms of natural catastrophe resilience for New Orleans than we were before Katrina happened. So, is it always the smartest idea to do something quickly? In the excitement of the moment, it would be hard to push back. I mean, I don't want to get on CNBC after a natural catastrophe and tell people not to rebuild. But the time to have these conversations is not during crisis, but when things are calm, and say, well, we know where the most at-risk areas are. We can quantify this numerically. At the very least, let's stop building in these areas that are so prone. I mean, you look at something like, and I want to make sure I get the numbers right on this. You look at something like NFIP claims, and it's super 80/20, 90/10, where the properties that are consistently making these same claims, it's not like a new place every time. The water keeps flowing downhill to the same areas. So if we need to go back to our economic principles, that we have this idea of allocation of scarce resources with alternative uses. It's going to be your cash. And that there aren't necessarily solutions to problems, only trade offs. Then for me, it seems intuitive that we need to start pushing more toward smarter resilience investment, managed retreats, and not making the problem worse. What's that expression? Like, if you're in a hole, stop digging. Something in that capacity. So we have these analytics. Let's use them.
yeah, it's almost as if, and we're getting some questions that I'm sure Rich will get to here shortly, but since I don't have my reading glasses on, it's almost you're bumping up against human psychology.
Sure. Yeah.
How long have we heard about problems with Social Security or Medicare funding
Mhm.
and really not done enough? Or humans who, I know I got to clean out my garage, but I don't need to do it this week. I'll do it sometime. Uh, you know, they put these things off,
Mhm.
but things aren't getting any less expensive to rebuild,
Right.
certainly.
Mhm.
So it's a real problem. Rich, what kind of questions do we have?
Got some great questions that have come in the chat in the Q&A. My good buddy Faith, have you heard others talking about the Nat Cat concept of a social security-like collection of money from borrowers in the close of each purchase transaction to fund some of these climate events?
Have I
He
heard
has
of?
now.
Yeah, I mean, just when I hear about big programs, that's not the direction I would take it. And it's a tiny bit of rhetoric, but if society can't afford something, then how do we expect to afford it with a bureaucracy to administer it? We can look at these properties that are already priced by private sector insurance companies that are skilled at assessing the risk. So why not get out of the way and allow that risk to be priced in an actuarially fair way so that they can collect the premium that's appropriate for what the risk is? I don't think that we need to have these, and again, this is my opinion. I haven't studied the issue in depth, but it seems like that's more of a solution seeking a problem where you have, more government, more agencies, big new program. And I kind of keep coming back to this, we're looking just in a fiscal sense, and this comes up in the climate literature, that we have trade-offs that we have to make. And the better the fiscal position of the sovereign, this is in the monetary literature, the better fiscal position, the better outcomes they're expected to have in climate. Last I checked, the US and Uncle Sam, not so great. Doesn't feel like to me like the solution to an insurance issue is more funding, more regulation. Again, that's my opinion. I have to read a bit more about it though.
And then same church, different pew. I think we can all agree if former President Trump wins, we're not going to see any additional regulation to the mortgage industry. Although you paused there, but I guess that my question would be, could you see any additional regulation, kind of related to climate risk for mortgage lenders, over the course of the next 3-4 years here?
Yeah, well, I think that because the banks and the big agencies have already taken the first steps to quantify what the climate risk is, I don't think that it's all of that dependent on the executive branch. I understand that there's the FHFA relationship, and you appoint a new director, presumably that could go in a different way. But if I were to try to think like, what does a Trump administration look like in terms of climate? Well, there's a wide body of literature suggesting that Midwestern states, smaller states that don't have natural catastrophe exposure in the same way that coastal states do, are subsidizing the risk for the coast. So if that information is true, it kind of doesn't matter whether you believe in climate risks or not, as much as you say, hey, why are my constituents subsidizing these other states? That seems like a fairly straight line that you would at least push for more investment in the existing analytics to price the risk accurately, make sure that those who are getting the benefits are picking up the premium as they should. I mean, it's not, for 2 years I lived in rural Minnesota, I lived in Albert Lea. If I find out that my premiums for property insurance were more expensive because adjacent states had some regulations or restrictions that were preventing them from pricing the risk as they should, that becomes a political issue for me that I would want to advocate for, and that I would expect my elected officials to champion.
And then one more really good question that came in. How does the continued increase in home building relate to the increase of surface temperatures, possibly leading to a bigger factor of said climate change? For example, tornadoes in areas where they were not typically, as an example.
I'm not sure I understand the connection between home building generally. Is that this idea that the carbon emissions from construction are somehow contributing? I can't connect those two. What I can say is that I don't see a path beyond reducing growth with the expectation that we can limit carbon emissions. And that, go back to politics, I don't see that being particularly popular once people actually have to digest the losses instead of just talk about it. The observations of weather patterns shifting, it's real. You'll see storms where we didn't necessarily have storms before, but some element of that is also people are watching closer. They're reporting hail more often. I can tell you that those severe storms, just from an insurance perspective, are difficult to handle, because insurance works best when you have these periods of no claims to build up a surplus and a risk appetite, so that if the big event does happen, you can pay out and then have this expectation, true or false, that you'll be safe for a while to kind of recoup premiums. If you look at something like how severe storms have manifest, that's a little bit of damage everywhere. So that reduces the benefit that you had from diversification and gives you less time, if it's happening every year, to recoup the premium to continue to take the risk. So really tricky to model, tricky to insure. Yeah, pause there.
So what does Verisk do? Your company, what does it do?
Sure. Well, we have a number of businesses. My division, we have something like 120 PhD researchers on staff. We're a partner to the insurance industry, working on natural catastrophe modeling, data analytics. Huge company, like $34 billion market cap. So that kind of scale really gives us not only an opportunity to partner and have feedback from the reinsurance and insurance industry, but to invest in these advanced analytics. And it's my conviction, my firm belief that we're actually ahead of a lot of universities in terms of the science and our understanding of the relationship between climate change as it may manifest in the future and how that relates to the different natural hazards.
So who owns the company? Is it publicly held?
Yeah, shareholders.
Great. So Kingsley, thank you for today's stock tip. But how would a lender, I assume you work with lenders
Sure.
or
Yep.
servicing buyers. What do you do for them? Let's say, going back to the example I had earlier, let's say you own a small or mid-sized lender in Florida or the Southeast. What services do you provide that lender or that servicing buyer?
Sure. Well, we provide them the same view of natural catastrophe risk that the insurer uses to set the premiums. So we have banks, we have larger financial institutions that will take these models and put the collateral through the analytic and say, how's an insurer going to look at this? How should I look at it? We have some like bread and butter metrics. You have the average annual loss, which is over the long term, what kind of damage you can expect to the property or portfolio. But maybe more interesting is the tail risk analytics, which say at a certain probability, you can expect your loss to exceed this value. That gets really interesting. So how would a lender or servicer use that type of analytics? There are two ways. One is say, what is my climate adjusted loan to value? Let's look at a scenario where a bad hurricane hits, and the 6 largest banks in the United States went through this as a Federal Reserve climate scenario analysis exercise. They said, let's hit a severe Northeast hurricane against my portfolio. So we provide the hurricane, we provide the damage function and overlay the insurance terms and say, what is my risk of loss there? What does the building look like after insurance, after the natural catastrophe? And that's your climate adjusted loan to value. You can take it another way. And because the software and the systems are designed to handle extraordinarily complex insurance terms, like I was wowed when I saw, wow, this is really more than I thought in terms of limits, deductibles, take-up rates or coverage in a given area. So they can overlay these analytics and say, if I have these stresses in the future, which should some way be related to the existing natural catastrophe risk, what does that do to my portfolio? Do I have properties where I have high loan to value and low debt service coverage, and I find myself in a potentially stressed zone? Well, I need to look at that. I shouldn't pay the same amount for that loan as I do something that has no natural catastrophe risk, all else equal. Without the models, you don't have this insight, but the insurer has this insight when every year they get the opportunity to either raise your premiums, reduce coverage, or just pull out of the market.
This is The Big Picture, part of the Chrisman Commentary network of shows. And this week, really pleased to have Kingsley Greenland on as our guest. He leads the mortgage risk analytics practice at Verisk Extreme Event Solutions. And Kingsley, I'm assuming Verisk, you guys are using a myriad of different emerging technologies like climate data analytics or AI. to help guide your business and your clients? Is there any emerging tech or AI that Joe mortgage lender or Joe real estate professional can use to, help them assess and mitigate climate risks for themselves personally or their business?
Right. Well, I think it's convenient that pick the largest insurers in the world. They're going to have teams of people using the software
Mhm.
to price and analyze natural catastrophe risk. That's appropriate for the largest banks. Call it the 40 banks in the US that have over 100 billion in assets. My view, candidly, they should all use the Touchstone software, both in terms of portfolio management and loan origination, to understand what their catastrophe risk is. There's no better solution. But for smaller lenders, it probably makes more sense for an entry-level analytic, which is a score that's kind of close to something like FICO, where you can just use it as a quick screen. And it's still sitting on top of the guy I already mentioned. We have 100 researchers doing this. Like, there's no one, it's the best you can get. So to have a simple 0 to 10 analytic where you have the confidence that it sits on top of the same models that the insurers are using, that's probably more appropriate for a local community bank.
Are they all in like one boiler room? All these analysts they're not in the room next to you. Can't pan camera.
I sit next to a couple of them, like real scientists. They're people, first and last names, regular folks. It's kind of, you read about scientists and you kind of think they're something else. But yeah,
I always wonder what happens to weather majors, right?
Yeah.
I'm majoring in meteorology. What are you going to do with that? How's that assistant manager job at Walmart going to work out for you?
Yeah. Well, times have changed, Robert. We have a lot of sharp people here who study meteorology, and we recruit from all the top universities. They get here, and that's an alternative. If you're a top student in a great research program, you study atmospheric physics. They'll offer PhDs in climate change now at some of the more well-known Boston universities. They can make that choice. You can say, hey, I can be a professor, or I can go work in natural catastrophe modeling. It's a niche industry. I think there are probably like a lot of, it's hard to get in, but once people land, why would you want to do anything else? Especially if you, or me, you get really lucky and you get to kind of sit in between science, insurance, and my first love of residential mortgage origination. It's just a great place to be.
Yeah. Well, when I buy my 10 shares tomorrow,
Yep.
I'll let you know, and you can start sharpening the pencil on some of their salaries. So
Yep.
I'm just warning you.
Yeah.
Kingsley, what about the mortgage-backed security markets? Do you anticipate any impact to that, like pay-ups for, pools filled with loans in nice, safe states like Ohio, where I reside, and Rob's risky wildfire ridden California? Maybe, lesser prices paid, and anything like that looming?
Well, they price off this, like RMBS is going to price off the guarantee.
Mhm.
So the guarantee is not going away. So if I'm looking at 30-year fixed, I say, well, it's not really a default thing. It's more of a prepayment issue. And for prepayment to happen enough en masse for that to affect my view of the security seems unlikely. That's an entirely different conversation if we go to something like private label or CMBS. Then a lot of folks are already doing those analytics where they say, wait a minute, I know the property location. I often know specs of the building. Like, year built is one of the primary determinants of resilience to bad weather. So if I have this information, then how can I not price it into the security? I get a little bit of pushback where people say, well, I'm at the top of the capital stack in CMBS, so I don't really care how the default manifests. I'm protected. Heard that before.
Right.
So fine, okay. But I think it's an unpriced risk in a lot of markets, especially if you look at the flood issue on residential and how we keep seeing these natural catastrophes where we know that the requirement to carry flood insurance in these predefined flood zones is not sufficient to protect the collateral against flood that we're actually seeing. So I don't know where that goes over the next couple of years. I privy to a lot of really interesting conversations about how to price it, how to manage it. But that's the big gap is flood risk in areas where the borrower is not required to carry flood insurance because the take-up rate outside of the flood zones is like 4%. It's about equal to earthquake in California. Like, people just don't insure the risk.
Interesting.
Yeah.
And the time has flown by today. I always learn a lot on this show, but maybe more today than ever before. This was a great conversation, Kingsley, and really appreciate you educating our listeners and viewers on this kind of budding issue in the real estate finance space. Any final takeaways or words for the lenders, mostly lenders?
Does Verisk pay a good dividend?
Rob is all in on Verisk stock.
So I think my closing words is that there's a lot you can read from the scientific community. There's a lot of research. If you're in your chief risk officer, you want to kind of get up to speed on what these are. The analytics are not new. They're mature. Insurers have been investing billions of dollars in these over the past 3 decades. So you can kind of rest on that and say, it's not going to be cheap, but you'll have access to some real cutting edge technology that, the risk return of investing now in climate analytics versus the problems that you can reasonably expect to be exposed to over the next 7 to 10 years, much less the next 30 years. I think it's a one-way street in terms of these types of models and these types of conversations having a permanent place in loan origination.
As former FHFA director Mark Calabria said on the show last week, the best time to fix the roof is when the sun is shining. It seems yeah. So there you go.
That was the lead into this week's show, I think.
Yeah. So, well, Kingsley, want to thank you very much for.
Yes, thank you very much.
Yeah, this week. This was great. A lot of nice comments in the chat. Very educational. Learned a lot. Love to have you back on in the new year to go back at this topic. Hopefully there's no more natural catastrophes that prompt you to come on. But this was very educational nonetheless. We really appreciate you joining us.
Yes, thank you.
Thanks, guys. Thanks for having me.
And and to our viewers and listeners, we do this live every Thursday at 3 p.m. Eastern. You can go to chrismancommentary.com to get signed up for that. Of course, this goes right to podcast and right to YouTube afterwards as well. And we will be back next Thursday at 3 p.m. Eastern. And until then, have a great rest of the week and weekend, everyone. And we will see you next week. Take care.
Thanks, guys.
Bye.